Let's jump right in. Please, one sentence introduction to yourself, your background, what is your firm, and what is the thesis of your firm?
Hey folks, my name is Dana Oshiro. I'm based out of San Francisco. Oh, there's quite a bit of. I'm based out of San Francisco, but I grew up in Richmond, British Columbia. Went to Steveston High. No longer exists. So the thesis of my firm, so it's Heavybit. It's an 11-year-old firm, and we specifically invest in enterprise infrastructure. And that has changed a great deal, so we can talk about that a little bit more. I typically write checks between $1 and $3 million into pre-seed through to Series A rounds.
Hey everyone, I'm Dom. I'm a partner at Ripple Ventures. I moved to Vancouver almost 2 years ago now from Toronto to open up our West Coast office, and our focus is anything crazy early. So we've backed companies at or near inception, pre-product, pre-revenue, no traction requirements, and mostly around B2B, AI, and infrastructure.
Hi, everyone. Thanks so much for having me here today, Chris. I've been an investor or working with startups for the last 25 years, so that's a few cycles. Most of the time as an investor, but in operating roles at the beginning and in the middle. The last 9 years, I've been running Pender Ventures, and we're a B2B and health tech early stage investor, investing at the inflection point between early commercialization and scaling.
Patrick Lohr, managing partner of Panache Ventures. Before this, I was an entrepreneur. I was co-founder in a company called iStock Photo. Quick story there is we sold it for $50 million US in 2006. 3 years later, it's worth $2 billion. So as a VC, I have a chip on my shoulder. So if I'm investing in any company, I will make sure that you don't pull the bonehead move that I did. I could have been a billionaire. So what we do today is we have a $100 million fund, Panache Ventures Fund 2, and we're writing up to $1.5 million into pre-seed and seed stage companies.
All right, so let's dig right into the thesis, right? So all of you have been on the investing side long enough that you started off investing before AI was really a thing. First question for you is, to what extent has the type of characteristics that you look for in founding teams or companies changed? So, I come to you, like the four of us come to you, we're eager founders, we're doing a thing, the thing fits within your thesis. What are the questions that you're asking yourselves as you are initially evaluating us? And to what extent, if at all, has that changed?
So I would say that as far as product is concerned, I see a lot of similar looking products with similar sort of abstracts around them. In fact, if you look at a YC demo day, you might actually see exactly the same summary for two different types of companies. So that makes it sort of hard, and that's a little different. What I am asking though, for the most part, especially since it's early stage, is like, what is the founder market fit? So do you have any experience with the particular problem that you're trying to solve? That's kind of like the biggest thing. And
Why does that matter?
I mean, it matters because if you're trying to sell to a particular persona and you don't know anybody from that particular persona, you're unlikely to be successful.
Tom?
Yeah, for us it's changed over time because I feel like maybe when I first started at Ripple 7 years ago, there's a really strong focus around founder market fit, but the speed in which companies are being built today has changed so much. So you kind of have to thread the needle of quality and domain expertise, but also how fast they can move. So I'll give like an example. If a founder has deep domain expertise, but they were a high manager in their last 5 years of their role, the ability to change gears to be a founder, individual contributor has changed, and the bar has changed for progress. So that's kind of how we've changed our thinking on what we'd like to evaluate.
So I would say what hasn't changed is sort of the longer term business fundamentals. So for us, is still going to be around what is your moat, your unit economics, and kind of your capital efficiency for our strategy and our size, et cetera. I can say in this AI world, I think it's a bit human nature to want to categorize companies to a certain extent, even though there's lots of gray. So what we generally see out there is kind of the more traditional enterprise came from the SaaS world. Maybe there's a little bit of dabbling in AI internally or what have you. Then there's AI enabled and then AI native. So for the maybe more traditional, I think those are interesting. I think still investable at the right price. I think still have to have a plan around AI enabled. That's what we would look for. I think there's probably in a lot of categories, they've been over-teched in a way. So what's still really different? And maybe there's more of a, given the nature of the market they operate in, more of a services component required. So all of that can still be a good investment, but that's kind of things we think about. In the AI-enabled world, we think that's very interesting. Lots of things to think about there. And I think probably the category where they're moving in more tandem potentially with the customer and the customer problem. So that's kind of easier, frankly, for us to ascertain. The AI native, super exciting. Can leapfrog, can be creating new markets, again, super exciting, but also kind of scary for investors that might have a finite timeline. And market timing, by the way, is one of the toughest things for us, because we too have to give back money to our investors. And also, I think one thing to think about, and we, as I mentioned, are in health, there could be, incumbents that decide to release something, that have a super strong moat that could, render even AI native companies, down to zero the next day. So we're thinking about those really big challenges for AI native companies.
For us, we think that we're looking for exactly the same thing. And we've always looked for founders that run through brick walls, founders that bend time and space. And so the way that we think about it is how are you doing the seemingly impossible? How are you as a founder gaining more insights than your peers? Because we'll interview thousands of founders a year, and we look at people in, let's say, the digital health industry that might, a year ago, 2 years ago, said it takes 2 years for a sales cycle here. And today, if you show up, we're expecting you to, best in class. You're closing some of these contracts in a month. That was impossible 3 years ago because of, product development and AI. And so I think founders are basically showing up and we're just kind of having a holy shit moment with their product development cycles and their sales cycles.
So I want to double click with you specifically, Pat. So for those who don't know, in a past life, Pat and I were partners at a firm. I know the diligence of questions in the ICs that you run, investment committees, right? So pretty detailed list of questions. And Panache, on basically a quarterly basis, is revisiting the questions that they ask when deciding whether or not to make an investment. So I'd love to know if there are questions that you have added or taken away to the investment committee since you and I stopped working together, right? So what has happened? What has changed in the evaluation?
Yeah, I think we still have the core questions around founder and product vision. Where is this company going to go? Because I think as founders, you're always starting off with a core use case, and it's a small kind of SAM, SOM, TAM kind of question. The question is, how fast can you get there? Tell us the plan on how much money you're going to need, how you're going to be more capital efficient than the competitors, how you get there faster. So I think that's core. We've probably put a little more emphasis on that. Probably de-emphasized the technology questions. So I think we used to do a lot of product walkthroughs and a lot of kind of churn and SaaS metrics kind of walkthroughs. A little less emphasis on that because, man, the cycles are moving so fast. You'll do a product walkthrough for us and we'll kind of go, yeah, whatever. because we know that you can go through an entire product iteration cycle in 2 weeks.
Okay, so I want to dig a little bit more into this question of velocity. I'm going to jump around because we've got 4 firms here that are at slightly different stages and slightly different focuses. So I'm going to start with Dana and Heavybit, since we've had a lot of conversation around developers and developer tools and things like that. When you meet a founding team for the first time, right, and let's talk about the earlier stage. So let's start with pre-seed and kind of that early stage. What are you expecting them to come to the table with today in terms of progress? And how does that differ from maybe a few years ago? And that could be in terms of maturity of the product, GitHub stars, whatever the metrics are. Like, where are the goalposts where I come to you with something and you're like, okay, cool, this is great, versus like, wait, that's all you've got?
At pre-seed, it's actually pretty hard because there are so few signals for you to look at. So the reality is like people are asking all these questions about whether VCs are using AI to diligence their early stage companies, and it's like, what data is there to diligence right now? You are making a lot of decisions around whether or not the founder is conscientious about their end user, whether they understand a particular problem area, and whether they are building for like the immediate or whether they're building for a longer product vision. So an example of that, for instance, is I feel like last year I saw 40 RAG testing frameworks pitched to me. And with a RAG testing framework, you could have some kind of superior effort on the front end of it, but the reality is every single person that is using a RAG testing framework is using every other free early stage RAG testing framework as well. So maybe it's a good way for you to pull in early community and build goodwill, but it's ultimately like a marketing loss leader into what a larger product vision needs to look like. Yeah.
And so how about you, Dom, right? You guys invest ridiculously early. What does ridiculously early in sort of a general thesis mean today versus 5 years ago?
I think it depends on the founder's experience and tenure. So what I mean by that is so we have like our RippleX program, so we have a lot of like student founders or like first-time founders coming out of their 1 to 2 years of experience. And I would say for those folks, when they come to us, we expect, because you have less experience, like hopefully the proof is in the pudding. So come to us with a really clear problem, come to us with at least an MVP so we know you can build something, versus if you've already worked at Stripe for 5 years as an engineer, like I hope to trust that you can actually build, or if you're a repeat founder, hopefully with a decent outcome previously, that like you don't have to have all the check boxes. And I think that's changed a little bit, especially today, where even the experienced founders are coming to us with something already, versus maybe, 12 to 24 months ago, a lot of founders that were, maybe ex-Stripe, or they sold a business before and they're starting the next one, like you kind of just raise with an idea on a piece of paper, and that's acceptable. But I think now there's a little bit more of a bar of, okay, the threshold is so low to get something out, so even if it's like some shitty Figma or some like lovable generated front end, like just show something. It just shows some sophistication. That's the bar, I would say, depending on founders and their tenure.
So just to repeat that for everyone, you're expecting them to show up with something now, right? Showing up on a piece of paper does not work anymore.
I mean,
in most cases.
Most of the time. But the other thing that I'm personally looking for these days is it something so technically challenging or crazy that you can't even show me a demo, and that's interesting to me.
Right. Okay. So bifurcate, right? So
Yeah.
if it is technically hard, right, that's still its own category. But if it's maybe more of a distribution play or something like that, like you're expecting to see something.
Yeah, exactly.
Okay. Now I'm gonna jump over to Pat. Same question because you guys are at similar stage, right? You talked earlier about the slight de-emphasis of the point in time of the product because it iterates. But you know, what's sort of the minimum threshold for like, yeah, you need to come to the table with this for me?
Yeah, it's been interesting. I think that AI has given the illusion to VCs that we're smarter than we think we are, and so, you know, we get these memos here that are just like all the subjects that I failed in university. So, you know, whether it's chemistry or biology, physics, and we're diligencing like the cures for cancer driven by AI. And it's like I have no right to be telling like some group of PhDs like whether or not their subject, whether or not their company's going to succeed. But I think ultimately what we're seeing as far as the diligence process goes is that they are coming to the table and saying this is the way that it's been done for the last 30 years, and this is the way we're using AI to give us 10x or 100x different results, right? And timelines, I think, for the most part, and capital efficiency, which if you think about it from an overall point of view, as long as the VCs don't get in the way of the whole process, that's always been the technology pitch. The technology pitch is always the VC says, look, we're capital providers, we want to support you guys. We have no idea how the product works, but you're going to bring sector expertise and you're going to bring product expertise. Tell us how our money buys the technology and buys a team to get you 100x faster. I think that's the core story that we're still looking for. But I think it's really widened out the industries that we're looking at. So we're literally looking at the cure for cancer. And we're looking at, we invested in a space weather company last year. And I think it's endless now because AI has creeped its way into everything. Everything's become digital and computational. And I think for us, VCs just need to get smarter.
So I'm gonna hop back to Maria on this, right? You tend to invest a little bit later, but you also invest in, let's talk about health, right? Regulated industry, so notwithstanding the cure for cancer, when you're looking at companies, have things changed in that area? We heard a little bit from Najid earlier about kind of how he's viewing the world. What are the companies that you're talking to now? What are they showing up with? What is exciting to you? And how is that the same or different than say 5 years ago?
Yeah, it's very interesting and very, I think, different in terms of a sector because trust is so important, which is all the security and does it actually work? Sort of the good enough is, you know, just doesn't cut it in a lot of areas in health. So I think when we're looking at things in the health sector now, it's really trying to understand, you know, what that mode is, and usually there's some really deep connection, insight relationship that they have, knowledge about whatever category within health. So that's key. That they're moving in tandem with their customers is key. I think how they're treating their data. So there is an enormous amount of challenges around data sovereignty, data privacy. So we have some companies in our current portfolio where a lot of the processing is done in the US, but it cannot be hosted in the US. There's different privacy challenges down there, as we all know, and unfortunately we don't have enough GPUs in Canada to do enough processing for some of our companies already. So looking at like some pretty technical issues actually on that side. But where I think the opportunities are, and we too are opening up our lens, I would say, is we would never before look at necessarily heavily regulated areas like diagnostics even. But now the regulations are changing. There's some AI decision support tools that are getting approvals. There's modules, et cetera. It is more capital efficient as well. So we're looking more and more at those kind of areas where we wouldn't have looked at before. And also areas around how to secure, you know, cleanse, enrich, all that kind of good stuff around data as well.
So I'm going to ask one more question, then we'll open it up to the founders here. We'll go down, we'll play a game of hot or not. And what I mean by that is I'd like you to each very quickly answer one or two industries or sectors that you previously would have invested in that you won't now, and things that you previously maybe wouldn't have that now you're like, yeah, this fits within our thesis.
I've been thinking about this kind of question for a while. Figma, like original Figma makes zero sense right now. Like it's built on this idea that you're gonna prototype with like pictures on the wall, and now it's replacing that with a new kind of lo-fi model of wireframing, and you hold that new picture up to the wall for a bunch of engineers to figure out if they can build or not. None of that matters anymore. Like new Figma, what it looks like now makes a lot of sense, but the original version I would have wanted to invest in, and it would have been hot garbage if they had not evolved, right? So that's my...
That's a cold. All right. And what's something that you're like, okay, this excites me now, and maybe it wasn't even on my radar 5 years ago?
What excites me now, but is not, I would not say I am a domain expert in, but I want to be, is data center greening, like some kind of eco-friendly data center type of thesis. Because the reality is, if the biggest, one of the biggest problems with AI and arguments against is environmental, then we should be looking at how to make data centers more sustainable.
All right. Dom?
Something that we are not as excited in the old context would be just like we do a lot of like B2B like workflow automation stuff. I think all of that's very much changing with agents and also just new systems of record. So I think we're not as excited about that. Where we're spending a lot more time thinking and starting to make some investments is around like what is the new software and infra look for frontier industries. So thinking things like space, like Pat mentioned, bio, energy, data centers, stuff like that is where we're spending a little bit more time learning about right now.
So I think I kind of mentioned we're broadening our scope within the definition of health, for sure. I think I also mentioned security, whether it's horizontal, and that's around data security, et cetera. I think an area we've always, struggled with and will continue is cyber. It's so hard. It's just getting harder, and someone should be investing in it. But it's so hard to keep up with the bad actors, and I'm not convinced it's an easier area to invest in because of AI either.
I think we're trending away from e-commerce. That's been a trend for the last couple of years. I think B2B SaaS tools that are these little processes that you might charge $50, $100 a month for, I think that's becoming less and less attractive. And again, we're getting much more aggressive and optimistic about what AI can change. And so one of the core areas in enterprise that I think could be really interesting that AI has a huge chance of changing are things like the middleware problem. So you have big enterprises out there doing a ton of acquisitions. They might run 15, 20 major databases that don't talk to each other, right? And technology's been trying to get at this data issue, and you know this, Chris, this is your world. They've been trying to attack this for the last 30 years. I think AI has a chance of getting there. And then that's the behind the scenes stuff, the boring business stuff that I think we're just going several levels up and getting way more aggressive. And then as before, like we are looking at the stuff that we have no rights looking at, which is cure for cancer. Like we've been screening a couple of those things, and we're probably gonna make a bet or two in that space.
All right, so we've got time for a couple of questions here. We got orange over here. Love the color.
My name is Ali. I want to get into VC's head and how you think. And I want to ask kind of two questions. One is, how, nowadays, tomorrow, maybe a company become a unicorn or completely vanish because another AI came out. Then based on this concept, how do you come up with valuations? How you might have changed your valuation strategy for the companies? And the second question is, obviously any company 2 to 5 million ARR is really sexy for VCs. But what are the other stages, maybe a top 2 stages from a startup, which is still interesting for VCs to invest in?
Let me grab that one real quick. I think valuation, if you're thinking about it from a spreadsheet point of view, you're already wrong. And so there's a great talk out there by Aswath Damordhan, who teaches at Stanford, and he basically talks about valuation as both numbers and narrative. And so the example that he says is Uber is just a taxi company until it says we're a data and logistics company. So you got to show the TAM and the numbers and the margins off it, but you got to tell the story around it. And this is the part where we at the earliest stages, you got to be able to talk about your company from not here's the spreadsheet of what it is now, but what it could be, because this is the way we're going to bend space and time and change the world. And so I think coming out of the gate, Uber was able to tell that story. And I think most founders that spend too much time in the spreadsheet are going to suffer on the valuation front.
All right. Anybody else? Anything to add?
I think the honest answer is valuation is a function of the investor justifying their check size and their ownership targets. I think that's the only thing that's really true in valuation. So I'll give you an example. If a fund is writing $500,000 checks and their ownership target is 10%, they're going to price the company at $5 million post. And most of the time in early stage, it's as simple as that.
Yeah, I will also argue that if you would like to drive up your valuation and retain more ownership as a founder, get more than one term sheet. Like, make it as competitive as possible, run a process, right? It's not like you were discovered at a mall. You can run a process and you can be like, this is the order in which I want to talk to people, and I want a term sheet in hand when I talk to my ideal investor.
Nothing drives up valuation like competition. Yeah. Okay, we got one there. We're going to go rapid fire.
Sorry.
All right, given that this is BC Founders Day, I have to ask, if I'm raising a pre-seed round, should I raise in BC or go down to the Valley?
Look, whether you're raising here or in San Francisco, there's no magic beans in San Francisco. You have to tell the story. And I would say that there's great VCs everywhere in the world. You got to tell the story. And in fact, I think you got to tell a better story in SF.
Competition drives up valuation. So fiduciary duty as a founder of the business is to have options.
All right, we got time. We got one back there. I see you. Stand up.
Run.
Hi, my name is Kenshi. I have 2 questions. The first question is, given the leverage of AI tools, how do you see the capital formation requirements of companies changing your models past the early stage? And the second is, how do you guys think, it feels like there's been a cycle of B2B or SaaS for the longest time. Are you seeing any interesting opportunities in consumer?
So on the cost side of things, like, yes, it has gotten cheaper as far as, kind of individual schlep work of startup. But that being said, the cost of infrastructure remains at an all-time high, at least for a lot of my companies. Yeah.
Okay, and anything exciting from the consumer side that anybody wants to open?
AI browsers.
Say again?
Our team's been playing around with Comet a lot. I think AI browser is an interesting opportunity, but without stealing all my data.
All right, we got time for one more. Yep, you, Gray.
I've got a question about NoCap. So my name is Chang Han, Innovation UBC. One of the trendy topics in backrooms is AI agents like NoCap taking over industries and replacing doctors, lawyers, investors. So for all the panelists, I'm curious, how closely are you following NoCap? And is this an existential threat for you in your personal career?
Is AI going to make you all unemployed?
Yeah. Absolutely. I think everyone wants to think that, that they're so unique and their insights are so good that AI can't come after your job. I don't think we can be that precious about it. I think that what we're already seeing in our firm is that the load just over the last 2 years on what we're asking analysts to do. Like, I used to hire analysts 2-3 years ago to write investment memos. That job is gone, and so that completely changes what our investment analysts do. And I think we'd be lying to ourselves if we didn't think that was going to change a partner's job. I don't know how exactly for now, but it will change.
Yeah, I mean, I agree with that. We actually hired a data analyst last year. And I think that's really, frankly, so that we can keep up with everything that's going on and, you know, leverage it all and try to keep ahead of it and all of that. I do think, hopefully, the human aspect and the relationships, at least for a while, is really what can, you know, be the other reason why we can go at this longer as investors, for sure.
All right. Well, thank you very much all for joining us. And go get to your LPAC meeting.